U.S. inflation slowed in April, coming in at lower than expected at the annualized rate of 2.3%. So let's go to Leo Feler on this. He's a chief economist at Numerator and joins us now to talk some more about a few things going on in the U.S. Thanks for joining us today.
Yeah, thanks for having me.
So we are seeing some of the tariff difficulties work out, latest talks with China and the U.S. on the weekend, and a pause of tariffs there for the most part. What impact do you expect tariffs to have on American inflation, and when do you think we will see that?
Yeah, so we have not seen this in today's consumer price index report, which makes sense because the CPI is looking at what was happening in April, shortly after the Liberation Day and the tariff announcement. We might see the impacts coming in June, July, August. This is when we will have the delay in shipments that we've seen, right? A lot of shipments were actually held up, and we did not get the same number of ships that we normally have coming in to deliver the summer items. This is when I expect that we'll see some shortages and that we'll start having some higher prices. And then it's important to keep in mind, we still have about a 15% effective tariff rate in place, even after all these pauses in these negotiations that have taken place. We used to have around 2.5% tariffs this time last year. And so this is still going to be substantially higher prices that consumers are going to be facing. They just have not made their way into the consumer price index quite yet.
Okay, so as you know, the Fed chair warned about two things, higher inflation and higher unemployment. I'm wondering whether you think the tariff sort of truce, we'll call it that, changes the way he's going to look at that, or do you think just the general uncertainty is going to slow down growth anyway?
So I think the general uncertainty that we have right now is going to slow down growth and lead to higher prices. And, we perhaps shouldn't take for granted that when, we were thinking back in January and February, a 30% tariff was a really bad case scenario. And then we got this 145% tariff on China, which was just extreme. And now we are back to a 30%, right? So we are no longer at these absurd extreme levels of tariffs that we had just a couple of weeks ago, but 30% is still really high, and it's still going to cause a lot of uncertainty and a lot of economic pain. I think this means that the Fed is going to be looking at this and saying, all right, we're still going to be dealing with the potential for higher consumer prices, for higher inflation, and a potential economic slowdown, especially as what we're seeing right now happening, that businesses are essentially on pause in the U.S. They're not sure whether or not to invest. Consumers are being a little bit more hesitant, and they're saying that they expect much higher inflation, and they're saying that they're going to be saving up more because they are concerned about future employment prospects. All of that portends an economic slowdown that may occur during the next several months.
Okay, so as you know, there's been a discussion about people probably front loading their purchases, trying to get ahead of tariffs and a spike in the price. Do you think because we're seeing some of the tariffs unwinding, that perhaps in the coming months they will continue to spend because that there is that relief, even though they've sort of front loaded their buying?
Because consumers have front-loaded, and it's actually two front-loadings that we saw. It was consumers and businesses. So we saw businesses here in the U.S. go out and buy a lot of computer equipment to try to get ahead of tariffs. Once you buy new computers for your workforce, you don't need to go and buy new computers, a few months from now. And so, I think a lot of that front-loading has already happened. We had a pretty robust retail sales reports these past couple of months. And that signals that we're going to have a weaker one going into the summer months because consumers don't need to be buying a lot of these things that they front-loaded on already. It's possible, and we see this in some of our survey data, that some lower income consumers especially were saying things like, I would love to have front-loaded. I would have loved to have gone out and bought things ahead of higher prices, but I actually need to save up money to be able to do that. This might allow them a few more months to be able to save up money and be able to buy something in advance of the end of the tariff pause. Still, there's just so much uncertainty that it's unclear what consumers are going to do during these next several months.
I know at Numerator you sort of look at consumer sentiment, sort of what they think about the tariffs, how their spending objectives are changing, that kind of thing. What have you found as far as the consumer sentiment and reaction compared to what the Fed is predicting from those consumers?
So we actually did a paper with the Federal Reserve where we looked at what consumers were saying versus what consumers were doing. And so not surprisingly, consumers are exceptionally pessimistic. They are saying that things are terrible, the economy is doing terribly, they expect the economy to be doing terribly a year from today. And yet, even though they were saying these things, they were still going out and spending. So we have to discount a little bit of the consumer sentiment because it hasn't actually matched reality. Now, what they were very upset about was inflation. And inflation we can think about as, this thing that hurts a little bit every time, but it's not a massive shock. When consumers start getting concerned about future employment, that's a massive shock. Right, that goes. It's a binary outcome. You are employed or you are unemployed, and so when consumers start preparing for higher unemployment in the months ahead, then they do really start cutting back, and their pessimism actually does translate into lower purchases and into lower spending. That's what we will potentially see if the economy does really start slowing down in these next several months.
Okay, so give me a bigger picture. What's your outlook for the economy from where we are today?
I have been reluctant to give an exact forecast, and instead what I have is scenarios. And there's one scenario where it's all bluster, right? All this tariff talk goes away. These mass deportations are going to be something that's more for the media than in practice, and so we don't get labor shortages. If we go down this road where it's all bluster, the economy should be okay, right? Consumers are pulling back just because of the uncertainty, but we should be able to make our way through this, and the economy grows at maybe 1.5%, 2%. In 2025 and then 2026. If in fact we get, at the end of this 90-day pause, tariffs are back in place, if we do have mass deportations that lead to labor supply constraints, that lead to higher prices, if the Fed is truly combating both higher inflation and higher unemployment at the same time, then we might have a recession going into the latter half of this year. But there's so much policy uncertainty that it's unclear which trajectory we're going to be on right now.
Leo Feler, good to have you. Leo is the chief economist at Numerator. Thanks for your